Welcome everyone. Welcome to this Market Thursday webinar. We are Thursday the 7th of July 2022. And today we're going to be talking about the max pain before earnings. As always, a quick disclaimer, this is not investment advice, so please do your own research. And I do not take responsibilities for potential losses incurred. So if you are new today, or if you're new later on YouTube, just a quick background. I started to work in the industry in 2000. I started in Paris, worked for 4 years as a cash equity trader for a company called Pierre Charon Gestion. And then I moved to London, where I worked for a hedge fund from 2004 to 2008 for a hedge fund, Griffin Capital Management. Then in 2009, I joined Infinity Capital Market here in London, which is a UK subsidiary of First New York in New York, where I work as a prop trader with a absolute return mandate, no asset and region constraints. Since 2014, I've been mentoring people, mentoring traders, retail traders from all over the world. I used to work for another company from 2014 to 2017. I worked for ITPM, then I left in 2017. We launched after some people came to me and said, "Look, Greg, are you still doing some mentoring?" So I restarted the mentoring on my own in 2018, then launched in 2019 the 4x4 video series. And at the start of last year in 2021, we started trading my own book at Infinity as well. So today, what are we going to be covering? As usual, we're going to be starting with the situation across asset classes, stocks, credit, commodities, and FX. So if you're new, again, today or later on YouTube, this is something that we do. We look at the different asset classes and try to understand if what is moving, how things are moving, and obviously the correlations between the different assets. Today, we're going to be, after this, discussing the Fed expectations. At the end of this month, we're going to have another FOMC meeting and looking at those expectations versus the macro picture, talking about manufacturing, services, inflation, things that you should be quickly at least looking when you look at the macro. There's going to be very few slides on Europe, but even if it's the summer in Europe, it feels already like a winter is already here. Why is it so? We're going to be covering that. And then finally, we're going to be looking at one of the next catalysts for the next 6 weeks to 2 months, which is the earnings season. So what is coming for earnings? There is a lot of expectations. And that's going to be obviously one of the drivers. So when I prepared this webinar, I was a bit away in Paris for a few days, and when I came back, definitely, and as you saw on Tuesday, after this long weekend in the US with the 4th of July, there was a bit of rotation in the market. What we call rotation is when market participants go from one sector to another, and typically they are most of the time will be selling their winners and buying some of the losers. So they will be inverting their position. So 3 weeks ago, when I did the last webinar, as I told you, we were about to have the option expiry. And as I told you, very often when there is the option expiry, there is a reversal. There could be a reversal in the market. And guess what? On the Friday or the Monday, close to that level, we reached the lows at 3650 on the S&P. And since then, we have been up 250 points, so 5 to 7%. So that's the things that if you're looking for a reversal, why? Because the market is really much driven by options with the delta, with the gamma. So most of the drivers these days will be options related. So for those of you who have done the mentoring, who have done the 4x4, this is something that is not new to you. So that is one of the first things that we put in your calendar when we are looking for drivers. So next week we're going to have the option expiry on the Friday. Tomorrow we get the NFP in the US, which is for the jobs, and more importantly, from the 14th onwards, 14th of July, we get the earnings starting. So earnings starting with JP Morgan, which is most of the time really the first big company that is talking to the market and coming with their earnings. So why max pain in this market? Because literally, if you've been making money in commodities, in oil over the last 6 months until, let's say, 3 days ago, this week has been very painful because there has been some reversal. So commodities today have been bouncing nicely, but from peak to trough, they are down 20 to 30%. And oil WTI went to 95 very quickly, going from 110 to 95. So what happens when the earnings season is about to start is people are reducing their exposure, reducing your gross exposure. Why? Because if you get winners and if you're sitting on some winners, typically you'll be, let's say, taking some money out of the table. So what has been happening is until the last expiry, the market was one-way traffic, selling. Then we got the expiry, the market bouncing because new positioning, and actually the delta and the gamma helping. Now, for this week, we got some reversion. So even if the market actually is flat on the week, or even a small up, there has been a lot of volatility underneath, or a lot of pain for some people. So I know that if you're on Twitter, you'll see people that will tell you that they only are making money, that you only get the winning trades. I think today there's this guy saying, I bought the call, I'm making X. 2 days ago, there was this other guy, sitting on the beach saying, I'm making 30, 40%. And obviously over 2 months for my clients. Well, of course, this is what you're going to have on social media. The reality is very different. The reality is there has been a lot of pain in the market. So let's start with the situation across asset classes, looking at the year-to-date asset performance, where the picture on the left-hand side, which is for the index, are more or less the same, with the S&P down 20%. So the numbers are as of yesterday. Most developed markets are down 20%. But if you take this part as well of the picture, the US dollar is up 10% versus most currencies. That is true versus the versus the euro, where it's up 10%. So if you are a European investor, actually in dollar denominated, you're down 30%. So quite painful. So the picture is, risk off for stocks. That is not new. US dollar making new highs after new highs. Bitcoin, crypto, going from everything is fine to this is the end of the world for that space. And actually what is interesting is gold is not even doing the job, down 5% on the year. So as I've been saying for years and years, be always careful on playing gold as a long, saying, it's going to be a safe haven. It's going to be good against inflation. It's going to be good against the end of the world. It's not very often, it's not the case. So I'm not a strong bull on the gold at any point in time. WTI, that was as of yesterday. So potentially if you add 5% from today, that you make 35, 36% year to date, but it's coming from very high level. So it's around the 103, 104 USD. And it went to 122, 123 2 weeks ago. In terms of drivers for that space for WTI, that Joe Biden and his administration is going to the Middle East, so they will have to talk to the Saudis and potentially find some agreement. Not sure how it's going to play out, especially after the Biden administration being very aggressive against the Saudis over the last couple of years, and very aggressive against the oil industry overall. So week to date, why I'm using week to date, because that, again, we need to be looking at the different time frames. For the new joiners on YouTube, what is important is, as an investor, you need to be looking at those different time frames. That could be 1 day, 5 days, 3 months, 2 years, 5 years. But typically in a market that is moving that much, where stocks, today could be up 5 to 10%, we need to figure out what has been moving and what have been the moved recently. So if you look at that picture from Wednesday to Wednesday close, where the overall Europe was very weak. So that's the Euro stocks here, but that's true for the stock 600 and as well for the FTSE. That is even more true if you had the FX currencies, the weakness. So you had literally big weaknesses in Europe. Why? Because as we're going to be talking later, it is obviously very close to Russia, and this region is impacted the most by not having access to, especially for the Germans, to electricity, to the gas coming from Russia. WTI down 10%, gold 4%. So risk off for commodities. That started 10 days ago, or I think it's 20 days ago even. Most commodities have been down from agriculture to oil, to gold, to everything. So on one hand, you can argue that the market is now pricing a recession. As we have said over and over, for the WTI to price a recession, you really need like a massive recession. So in other words, the drivers for the oil market are still facing a huge imbalance. Why? Because Russia is not exporting the way that she used to. So there is an imbalance. So for the other commodities, similar, there has been a risk off. I don't think that we can say that is only the recession stuff. If you have been trading for more than a couple of years, you know that commodities traders that are playing commodities are really traders on steroids. So in other words, there is a lot of speculation in that space, and very often a move will be exacerbated. So yes, there was some, and there are still issues on the supply, but as many investors across the world were underinvested after the COVID crisis, you had not an abnormal move, but kind of, yes, an outlier move on that space. So let's go now into the next slide, if I manage to close that. Yeah. Here we're looking at sectors as always. Left-hand side, that is the sectors year to date, where XLE energy is only up 23% for the year after being up more than 35%. Financials, the dog, utilities doing kind of okay. Here on that picture, we have the same as the previous one with the WTI, which is energy down 6%. Another one that I wanted to show you, as always, is the bond market. So there is a lot of volatility still in the bond market. Here we are looking at the 10 years, the Treasury, the US Treasury, which year to date is up 143 bips, which is 1.4%, 1.43%. So we are now hovering around the 2.9% for the US 10 years. But week to date, yields have been coming down, meaning bonds have been bid. That's the same as before. Some scares of recession, US recession. If you've been following those webinars for more than 2 months, we have been pricing a recession potentially since the start of the year and been saying that recession will be coming and is coming in the US. Now it's all about how strong this recession is going to be. But this bond strength has been seen across markets, UK, Germany, Italy. For the VIX, now the VIX today is at below 26. I think it's between 25 and 26. So volatility coming down a bit. again, what is happening is we got some macro numbers, but more importantly, we are all waiting for the earnings season to start. So earnings will be really the biggest driver going forward with the FOMC. Next slide. This is the performances for H1 2022, looking at the different industries. And really the only two winners, if you put aside the US dollar, were the energy, oil services. But as you can see, there is, so here you get the S&P, which is your benchmark. And overall, you do have like a big jumps, or let's say big discrepancy between the winners and the losers. Where internet, social media down 40%, retail down 35%, semiconductors that we discuss when we look at the big picture at the start of this year in January. Literally, there has been a lot of pain across those different industries, and actually there has been some dispersion, whereas before dispersion was not that obvious. And before going into the technical analysis, looking at commodities, so this is the commodities from one Wednesday to yesterday's close, talking as we said about how commodities have been weak recently. So as I said, less speculation. I think there was some extreme short-term positioning where when you have a lot of people coming at the end of a trend, it's very easy to shake those weak hands. But literally most commodities over those 20 days are down 20 to 30%. So really there is a question mark of how much is coming from positioning and how much is coming from the risk of a global recession. So let's move now into the technical analysis. Okay, technical analysis as always. So here, this is a stock that we are looking today, which came with a profit warning. But looking at the S&P futures. So S&P futures, quick picture, and again, with technical analysis, take everything with a pinch of salt because there is a lot of discretionary into that, but that tells you a bit about what is the trend. So we made the lows here, 36.50 when we had the expiry. Since then, we have been bouncing. The trend is this one. So the trend that started at the end of April, where you had the acceleration in the sell-off. This is where we are. As long as we are in this trend, it's going down, obviously. In terms of targets, you know, if we start to move higher, the 39.50 of above. So I think that the first target now is 39.50. Then, you know, if we manage to break this level, we go into the 4,200 level. So that's for the S&P. Then we get the Nasdaq. So Nasdaq is picture is trickier. So you have a short-term resistance 1-2% from here. So we'll see, as always, the companies from the Nasdaq will be coming with their earnings a bit later. So most of the big companies or the companies that could impact the Nasdaq will come at the end of this month. So I think this is when the move could be done. One that is pretty clear and something that we discussed before is the Russell 2000, and here we are looking at futures. So the futures went bang on the support that we had before. So overall picture is, you know, how do you say that in plain English? Potentially an intermediate bottom has been done. At least, you know, as long as we don't break those levels, which is, you know, 36.50 on the S&P, 16.50 on the Russell, you will say that you can be constructive. I think in the industry, when people start to go long, they say that they are constructive. So this is your overall picture for the Russell here. So if you do a bit again of dodgy technical analysis, you know, that is your trend. So the trend is still down. We'll see how earnings will play out. Credit with the US 10-year, no technical analysis, but just to give you some picture about the volatility of the US Treasury. So literally from 270 to 350 here, and then back to 270. So we are talking, 30, 50, more than that, 70, 80 bips over a month. So that is just big moves. And another one talking about potential recession in the US. So that is the one. So that is the inversion of the yield curve. So again, something that we've been discussing over and over a long time ago, that is in the 4x4 when we do the mentoring. One of the good leading indicators of a recession coming is the inversion of the yield curve. So here we're looking at the 10 years versus the 2 years in the US, which is close to making new lows versus the levels that we had in April. So the market is again telling us that there is a recession, coming, that we are in a recession. Now the question is how deep this recession is going to be and what the Fed will be doing. Euro dollar, so euro dollar, talking about Europe. So now we broke the 10350. It's a one-way traffic for the time being. That will be interesting to check tomorrow evening, the CFTC, the Commitment of Traders positioning on the euro dollar, because it feels a lot like, this is the easy trade to be short. But at one stage it has to be, and there will be a reversion to the mean. There will be a painful trade because every market had over the last 2 to 3 months is reversion to the mean, and a strong move on the other. And the only one that didn't do that so far has been the US dollar. Some charts that I think are interesting. So Tesla, and I know that there are always a lot of retail traders that will be looking at Tesla. So Tesla is consolidating and it's ready for a big move. I can't tell you which way it's going to go, but what I can tell you is potentially you can be looking at options to be playing this move, this big move in Tesla. So we're going to have the earnings fairly soon. I think it's on the 20th. Maybe I'm saying rubbish, but I think it's on the 20th. So there is a lot of consolidation and ready for a big move. Another chart that I find interesting, that is this one. That is for the semiconductor, the Philadelphia semiconductor. So the trend is down. You remember, start of the year, everyone was bullish, and we have been coming down and down. What is Micron MU came with a massive profit warning. That was on the 1st of July, and since then it's bouncing. So interestingly, Micron, which came with this warning, is higher than it was before the pre-announcement. But if you look at the numbers, the sales there were, I think they were downgrading the numbers, but the sales by 20 to 30%. So somewhere the music is stopping. Another interesting chart, and then we're going to move back into the fundamentals, which is Alibaba. So Alibaba, this chart looks really good. So this is Baba. Actually, a lot of names. We are talking Prosus in Europe. We are talking Tencent. We are talking really a lot of names are behaving quite nicely. That should be put into the perspective versus the overall sector. I mean, tech and let's say risk-off, risk-on, which has been doing pretty well over the last 10 days. But that is one of the things that I will be monitoring, especially if China, you never know, is reopening to the world. Okay, I think this is it for the technical analysis. What about we go back here? Okay, so next slide. Looking at the Fed expectations, so it's a bit of I put everything under the same name. So Fed expectations, macro, if you want to call it. So here we are looking at two charts. The one at the top is the US break-even 5 years, and the one at the bottom is the US break-even 10 years. So for those of you who have no idea what that is more or less the expectations from market participants on inflation in the next few years. Okay, what you can see from those two charts is we are back to levels that we had up a year ago. Okay, so we had the craziness of inflation is big. Inflation is big. So we had the inflation. Okay, the inflation is there. We know that inflation CPI is above 6%. What we know now from those data as well, that inflation will be at a high level, but it's potentially peaking. Okay, so we're gonna have the second round effect of people all across the world asking for wage increases, and I'm pretty sure that if you're watching and if you've been an employee somewhere, you've been asking your boss to increase your wages, which actually it's tricky when you're trading because you can't ask for any raise. You just need to increase your sizing. But more seriously, inflation is peaking, and now market participants are telling you we are back to level that we had six months ago for inflation expectations. So against that, what the Fed should be doing, the Fed is looking at the big picture. So the Fed is not, even if they were pretty late in recognizing that inflation was more than transitory, they are now looking at the big picture, and they know that the economy is slowing. So here we are looking at two great leading indicators, which is the ISM manufacturing and the ISM new orders. And you see that the trend since we peaked at the start of the year, it's coming down. Okay, so this is your trend. So here, this is the leading indicator of the leading indicator. It's coming down. So recession is coming. Prices, unfortunately, are still very high. Okay, so it's 80% for the ISM manufacturing. It's the same for the services. I think it was 78%. So we are in a very high region, meaning inflation is there. Okay, so it's not going to come down very quickly, but the peak is done. Okay, so in terms of numbers that are going to be coming forward, you know that CPI, PCE, so CPI around the mid-month and PCE at the end of the month should be peaking, and meaning that you're going to have a hoo-ha-ha of, oh, look, the numbers are coming down. But again, the world is slowing. The world is slowing, not only the US, but the rest of the world. Good news is potentially China will be helping as they are reopening. Is it going to be enough? Potentially, China is more or less the same as Europe. So on one hand, you got China reopening and Europe that is going into a terrible season, which would be, if you think about it, as an investor, 3 to 6 months down the line, you are going into winter, and what's going to happen during the winter in Europe, if you don't have any gas, it's going to be pretty hard. So the only part of the world that is growing, it's China, because literally they are locked down here. So we are just a reversion to but overall, you see the trend here. The trend is peaking and we are coming down. So if I can look at it, potentially, I think it's fair to say that the Fed is doing exactly the same. So what is the market pricing now? Is the market, so here we are looking at the implied overnight rate and number of hikes, okay, from the Fed. So as you can see, roughly, the top will be down around that period. So at the start of next year, early 2023, we should expect the Fed to start to be, cutting rates again. Why? Because if you think about it, you're still going to have inflation that's going to be high for the next 3 to 6 months. Then potentially it is peaking. So you as an investor, the question is always the same. What is priced by the market? Okay, so the market is pricing. We get a peak in January, Feb 2023, sorry. We got potentially recession. We're already in recession. Leading indicator are calling for a recession. But you should be looking 6 months in advance. So 6 months in advance, a lot of things are already priced in, meaning, you know, you don't want to be the guy selling the bottom. I'm not, don't get me wrong, I'm not calling for a bottom, but I think now what you have is actually a lot is priced in, and very quickly, because it's only Jan to March next year, the Fed could be starting, at least not to hike, but to be cutting rates. So those are the Fed expectations. That's the same picture here looking at the euro dollar. So in orange, you get the euro dollar as of yesterday. So that's the euro dollar curve. And that the other one is from a week ago. So as you can see, everything moved up. So in other words, we are expecting less hikes from the Fed over the next 2 to 3 years. So if you look again 6 months in advance, that means potentially cuts happening pretty soon. Okay. Quick ones on Europe. Why winter is coming? Actually, this is a weird feeling being in Europe. So I'm in London. I travel to Paris. So the good thing is you see Americans everywhere in Paris and in London, because you know the US dollar is pretty strong. So they are 10% to 15% actually richer than they were a year ago, and that's even true for people in the Middle East, because you know with the dollar being that strong, that helps. So you do have like a positive of people traveling, but that doesn't mean that the economies are going to be holding. Tourism is not good enough, is not big enough. So Eurozone PMI flirting and coming close to the 50% level. So the overall picture is, you know, the only chart that we should all be looking at is the cost of electricity for Germany. So this is overall your chart. So you can argue, why is it going that high when, you know, it's winter, it's summer, you don't need that much electricity. Actually, what is happening is the market is more and more pricing that there's going to be a shortage of electricity over the winter. That is true for the UK. That's true for Germany. That is true for the UK. A bit less true for France, for instance, which has more nuclear power. But if you don't have enough electricity, first the cost obviously is coming much higher. So you get this double whammy of inflation killing your purchasing power, and more importantly for a country like Germany, a lot of its industry is relying heavily on electricity. That is the same in the UK. Some of the industry is relying a lot on the electricity, and that means they are not going to be in a position to produce as much as they want. So if you look at the euro dollar, if you look at the stock 600, if you look at the stocks 50, if you look at banks in Europe, so banks in Europe, if you look at SX7P getting close to a very important level at 150.15, so meaning that there is stress in Europe, there's going to be even more stress in the next 3 to 6 months. Is it going to be back to the story as we had 10 years ago, where, you know, market was selling off in the US when the European market were open? Then, you know, they say, who cares about Europe? It's all about the US. Potentially, but Europe is still making, you know, 15 to 20% of the world GDP. It is going to be slowing even more. And there's going to be potentially some tension, social unrest, maybe it's a big, too much of a headline. But you know that from September onwards, a lot of employees from Europe and all over the world will be asking for wage increases. So I won't be surprised, and you can bet on that as a French, that, you know, the back to school season in September will be tricky for the governments, but that will be true as well in Spain, same in Italy, same in Germany. So those are the things that we should be monitoring in terms of drivers moving forward. Earnings, what is coming? So as I said before, we are looking for catalyst, and an obvious catalyst for ID generation are the earnings. So every 3 months, what we have, we get the earnings season, and the earnings season will be starting on the 14th of July, more or less, with not only Basti Day, but as well with JP Morgan data. So I always look at the FactSet numbers, very helpful. Everything is coming for free. You can go there, putting your name on their mailing list. So what has been the picture is over the past 3 months, analysts lowered EPS estimates for the second quarter by a smaller margin than average and increased EPS estimates for the full year. So if you look at Q2 2020, I hope this is the one, there has been a small change in the quarterly bottom up. So far, the question is the following. Earnings are still, and sales have been holding pretty much well, both in the US and in Europe. And the question is it just because the street, meaning the analysts, are very late, and when they will adjust, it will be very painful, or because as you have decent inflation, and when I say decent inflation is 5 to 10%, mechanically you should see a top line and earnings based on those on this inflation, creating growth. So big question mark. I think it comes back to the idea that something that we discuss over and over, which is the capacity of the companies to be passing on the inflation. Today there was a good example with one company saying, we are not able to pass on. So for this earnings season, that is really the biggest question. In terms of the S&P 500, the change in Q2 2022 EPS from March to June, guess what? Energy, big winner, 38%. Why? Because in the meantime, oil went through the roof. So at the sector level, and I'm quoting FactSet, 7 of the 11 sectors witness a decrease in their earnings, expectation, with the biggest one being the consumer discretionary. So guess what? When the consumer is getting hammered by inflation, anything that is discretionary is being reduced. So minus 19% from one quarter to another, communication services minus 8%, and then you get the usual defensive with utilities, financials that is a bit less true, because if all the assets are coming down, then you realize that it's not really defensive. But other than that, energy, materials, and actually industrials are doing pretty well. So industrials mean we are at least, analysts are expecting this cycle to hold. I think to me it's mostly due to inflation, but the underlying is not that great. So earnings. So this one is coming from Bloomberg. So this one you can't have access to it unless you get the terminal. But the previous two spreadsheets data you could have it. So here we are looking at how the market participants have been looking at the year-on-year growth for earnings, revenue during different periods. So here that was on the 22nd of April, and this one was at the start of this week. So what you can see from the earnings year-on-year growth is we literally bottomed around May, end of May, beginning of July. So that was when we started. If you remember, in May, this is obviously when we started to have the acceleration in the sell-off. Then in June, we get the second wave of the sell-off based on the option expiry and the option. But overall, if you look at that picture, literally most of the numbers will have been, let's say, reaching a low point at the end of May, beginning of June. So since then, no downgrading of the numbers. Similar here, if you look at the option, Rory question on what's the function. I think if you look at BI, so you look at BI and then you press go, and then you look at S&P estimates, something like this. Top of my head, I think this is a new one from BI on Bloomberg. So On this one, we are looking at the revisions for the different on the different quarters. So I think the lines that are important, this one. So you see the trend from revisions up. So something we discussed over and over and over up till last quarter. For 8 quarters, the companies managed to beat the expectations like way above average. Okay, we are talking 80% plus for the earnings, 80% plus for the sales, or a bit less. For almost 2 years, investors were used to having companies like beating the numbers big time, whereas starting last quarter and potentially this quarter, revisions of earnings have been not as strong as before. So in terms of momentum, you go from a lot of excitement and companies doing very well, so you can where companies were beating and upgrading their numbers, to actually, since the start of the year, not that much beat. And the reality, that is something that I discuss in details in the 4x4. The equity market typically is very much driven by the economic cycle and is very much driven by earnings. Okay, so if you don't have any earnings growth it's going to be obviously very hard for the S&P, for the equity market to go much higher, and that is even more true if in the meantime, as we've seen recently, the banks are more hawkish than before. So you have, when you look at the valuation of a market, you get 2 components mostly. You get the multiples that you'll be using for your PE, and you get the earnings growth. So multiples came down because yields have been going up. Okay, so that means your WACC, that means when you do your DCF, everything comes down. Then if you look at the earnings growth that normally is, let's say, between 7 to 10%, we know that you could have 1 to 2 one-off based on inflation, but then it's going to be an issue for margins, and those earnings could be coming down. So what I'll be looking is very quickly, when you start the earnings season, is very, very early days. You'll be looking at what the companies, how the companies are beating, what they are saying for the next quarter, because this next quarter is going to be extremely important. So far, I think companies were able to pass on inflation. Now, big question mark at how we move forward in this in passing on those price increases. There is a question: do you always do a DCF calculation when working on a trade ID? So when I joined a hedge fund like in 2004, one of the first things I remember, I was sitting next to an analyst, and I never did it. At that time, I never did a DCF. So I kind of pretended, I need to do something. I need to do a DCF model. So I put everything on an Excel spreadsheet. And then when I did the Excel spreadsheet with the DCF, I realized 2 things. Is first, the WACC could change a lot, but actually the most important thing in your DCF model is your end value. Okay, so the value that you put 3-5 years down the line, and your multiple. So I knew that, if you put 100 instead of 120 and you use a multiple of 12, that will change your DCF model like crazy. So in other words, if you ask me if I do DCF model each time I do a trade, I don't. Okay, but what I'm interested in is actually knowing when we do the mentoring, the first thing that we do, we look at what happened before and what's going to happen next, and we look at the sales, and we look at the margins, and we look at the capital structure. Okay, so this is the things that I'm interested in. Then I'm going to be looking at the multiples. DCF, I just don't do it, potentially because I'm not smart enough, and more importantly, because literally I don't have the time to do it. What is coming? So earnings. So this one is from SocGen. And what is interesting as well is you see the expectation from the overall market participants. The top here, the max was at beginning of May, and since then expectations have been coming lower. So April, May, those are the times that they start to come down. Is it going to come down enough? What you have is, as I said before, you got a very strong correlation between how the market is behaving, and you are talking S&P or here like the MSCI world, where, don't get me wrong, MSCI world I just checked today is 60% is the US. Okay, so MSCI world is MSCI US with a bit of world, 60-40. But what you can see from here is when the profits are coming down, the prices are coming down. Or actually, if you look here, which is the leading indicator, are the prices, what it's telling you is the profits will be coming down. And that is it's not new. We know that the market is now pricing two things. It's pricing more than two things. Actually, it's pricing top peak inflation coming down going forward. Secondly, that we are in a recession, and you know, the speed or the strength of the recession, we are not sure, but we know that in the next, potentially February, March next year, the Fed will be stopping this hiking rate cycle. Okay, this is what you have in the market. We know that earnings will be coming down as well. So in other words, at the time being, you do have a lot of things that are priced in. If you remember 3 to 5 months ago, when the market was at 4,400, I said, you know, 3,900. I think 3,900 is a good target. We pushed to 3,650. So 3,650. Again, I think more importantly than doing a DCF model for the overall market, what you should put into your overall valuation is, you know, what are the multiples that you'll be using, and what kind of earnings you are expected to have. For the time being, literally we are still around this 3,900. I can't tell you if we are going up or down. It feels like, you know, in terms of option, in terms of short-term, you know, momentum, we are going up. But when I say that, you know, short-term is a weak. If the earnings are bad, really bad, and the expectations moving forward for Q3 are really, really bad, then I think the market will tank. Other than that, you know, either we stay here, I think there's a good chance we're going to be hovering between, let's say, 3,750 and 4,100, 4,200. But you really need a shit show to be happening in Europe, a shit show to be happening somewhere for the market to go much lower now. What I can do to help you on top of those brilliant webinars is the trading community. So trading community, we switched to Discord. So now we are only on Discord. We get different sections from trading macro, long IDs, short IDs, risk management, and so on. We try every single day to help each other. That is obviously a community, so that means if people want the community to work, they have to be proactive. But I think it's making sense for everyone, and I like it very much. Second thing that I do is the 4x4 video series. So I built the 4x4 in 2019. So you're gonna have 50 Excel spreadsheet, 40 videos, 30 hours of videos. So I built a 4x4 based on two things. The first thing is I've been working in the industry for 20 years, long only, long short, prop trader. But as well, I worked as an educator. So I started in 2014, and I knew and I know where people have been struggling, where still people could be struggling, especially with other education. So this is my video series. And then I didn't change the Saturday, 25th of June mentoring session. So we had a mentoring session for the trading community, but I do mentoring. So this is one-on-one sessions that we do on Zoom over 3 to 5 months, where I help you getting an investment process, getting a structure, how to structure the trade, how to make money. I know that some people these days, educators, are telling you that you're going to be making 200, 300% every year. Unfortunately, with me, it's not going to be 200 to 300%. So it's going to be more realistic. But yes, that is something that I enjoy to do. So that is it for today. I hope you enjoyed it. If you are watching later on YouTube, if you get questions, you can send me an emails like some of you were doing today. Question, how do you mainly trade stock or some options? I trade mainly stocks and I do a bit of options as well. I do. My background is mainly stocks. Options has been very much in hype over the last couple of years, last 2 to 3 years. And many retail investors, or should I say traders, have been losing a ton with options. And I think why? Because it's in the US, you need to have leverage. So in Europe, it's a bit different. So in US, you need to have a lot of, if you want to have access to leverage, you need to be using options. So a lot of educators are not completely stupid. If they want to enter the trading education in the US, they will tell you that options is the new paradise. It's a funny thing because those same educators are the ones that are telling you to be careful, that were telling you some years ago, be very careful with options, with leverage, that you should not be following charlatans. So long answer for short questions. I do options, we do options as well when we do the mentoring for risk management, for structuring the trade. This is covered as well in the 4x4 video series, and I do both, but this is what I do. Okay, everyone, thank you very much for joining today, joining later on YouTube. If you get questions, again, website or sending me an email directly at greg@duponttrading.com. Thank you very much. Potentially see you in 2 weeks. Otherwise, maybe later. Thank you all. Bye-bye.